Well, hello and welcome to the Vinva quarterly video update. My name is Mark Burgess and I'm joined here by Portfolio Manager Steve Malin and Founder and Head of Investments Morry Waked. Welcome, guys.
Thank you.
Thanks, Mark.
Well, I might start firstly by recapping the fact that I sat down with Morry a couple of weeks ago and did a podcast and we discussed all things Vinva and systematic equities. Perhaps if we start there, Morry, for those that may not have seen that, maybe explain what is systematic investing.
Yeah, in a nutshell, systematic investing is really about taking a range of information globally and using technology to process that information efficiently and incorporating that into our portfolios in a systematic and unemotional manner. And what we're trying to do in our process is really capture the best of all worlds, a range of fundamental insights, some technical insights, some global linkage models, which allows us to model the interconnectedness of many companies around the world, put them all together in a single investment process and create portfolios for our clients that are what we refer to as style neutral, that can pick up the equity risk premium. And if we can deliver 2, 3, 4% alpha above the equity risk premium over time, that translates into an enormous amount of accumulated wealth for our clients.
Well, thanks, Morry. With that backdrop, the last quarter we've seen a lot of volatility in markets driven largely by the well-publicised Trump tariffs. But if we take a 12, 18-month view, perhaps if you can share with us your observations and what you're seeing in those markets.
Definitely plenty going on. 2024 was a pretty strong market, pretty robust, very sort of tech-led, quite growthy. And in actual fact, we started this year in pretty good shape. We were talking about decent economic landscape and inflation being under control. And January is a strong month for markets. It feels like a lifetime ago now, but it was. But you'd already probably started to see a couple of little cracks appearing here and there. There was the on again, off again, Canada, Mexico tariffs that certainly spooked the market a little bit. And you also had the arrival of the Chinese DeepSeek model, which certainly sent a bit of a shockwave through the US tech stocks in particular as they started to get to grips with the fact that maybe their moat wasn't quite as broad and deep as they thought it might have been. And then when we got into February, we really had a bit of a lackluster reporting season out of both the US and locally here in Australia. And that set the tone to be certainly a little bit more bearish. The outlook wasn't looking that great for a lot of companies, locally, particularly in reference to China, and obviously the impact of the Trump tariffs hitting that market too. And then you get through to March and really focus shifted 100% to those Trump tariffs, and it was a pretty ugly month for markets in general. And that sort of flowed through into April, where we've certainly seen very elevated risk.
If we're thinking about that risk, and you offer both long-only funds and long-short funds, both globally and domestically. If we start with long-only, how have those funds performed and what can investors expect from those?
Yeah, from an investment perspective, both our alpha extension and our long-only funds, we refer to them as beta-1 strategies. They're strategies which we fully invest in equity markets on behalf of our clients. We believe that clients have made that asset allocation decision, and when they've entrusted us to manage equity portfolios, they want us to be fully invested. And we're also big believers that time in the market will always outperform trying to time the market over time. So if you look back over the past 12 to 18 months, both our long-only and alpha extension strategies have done very, very well from a total return perspective, but also from an active outperformance perspective, in line with what we expect. And that outperformance has really been driven by a range of factors. As I mentioned before, we're style neutral. Our portfolio outperformance is not driven by a particular style or systematic bias in the portfolio. It's basically stock selection within country, within industry. So it's pretty much a pure stock selection strategy. To Steve's earlier point, some of the uncertainty around the economic uncertainty, there's still a bit of jitteriness around inflation, whether that's under control or not. It's still tracking a little bit higher, at least the core price indices are above the Fed's 2% sort of level. And then you've added to that the Trump tariffs. We've seen obviously the market total return sell off quite aggressively, in particular over the past week or so. Our funds aren't immune from that from a total return perspective. As I said before, we are fully invested, but over time, the equity risk premium will outweigh trying to time the market. And from our alpha perspective or outperformance perspective, our funds have held in as we would expect from a style neutral strategy, so pretty much of a muchness relative to the benchmark. And in particular, our alpha extension funds globally have had a very good quarter. They've outperformed the broader equity market by over 2%. And that's the benefit of having that extra bit where we can take advantage of negative information in mid and small caps by going short in those segments of the market globally.
Thanks, Morry. You've talked a lot about both alpha extension and long-only products. Perhaps, maybe I'll return to you, Steve. If you can just talk about the differences between alpha extension and long-only and what you're trying to achieve with both of those strategies.
Sure, thanks Mark. Firstly, let me say we're very excited to be able to bring these products into the wholesale retail market. We've been managing these products for a long, long time, but this is the first opportunity that we've had along these lines. Okay, so what's the difference between the alpha extension and the long only? Well, really, the alpha extension is just a higher tracking error, higher active risk version of the long only. And what we do is we introduce a little bit of shorting. This enables us to keep the portfolios very broad, but also take advantage of what we believe are our abilities to forecast underperformance from stocks. If you think about the way that benchmarks are constructed, you may have a very negative view on a very small stock. In a traditional context, a long-only context, all you can really do is not hold that stock, and that's where you get your alpha from. And in the alpha extension, you can take negative positions. So let me give you an example. A company called Albemarle, lithium company that some people may be familiar with. It has some operations down here in Australia. Very small stock. The most that we could do in our long-only portfolio was to not hold that and create an underweight position of 1 basis point. In our alpha extension, we're actually able to create a short position around about 30 basis points, so still very modest, very risk controlled. This is just one example of many across the portfolio. Now, we correctly forecast that stock was going to underperform pretty dramatically last year, and obviously having that negative position, we were able to benefit from getting that view right.
Finally, to wrap up, can you maybe, any key messages that you'd like to leave investors with as you look forward into these markets and what to expect?
I think anybody looking to make a big market call right now is probably being a little bit foolhardy, in my opinion. One thing that we would probably highlight is that we're likely to see a period of elevated volatility going forwards. Where do you want to be in that kind of market? If you look at the way our funds are structured, we tend to be in every country, we tend to be in every sector. We're very neutral as far as macro risk is concerned. So if you're looking for benchmark-like risk profile in a difficult environment, with the opportunity to add a little bit of alpha here and there where we find these little alpha pockets, then certainly our funds sort of tick that box.
Just broader from a market perspective, one thing equity markets don't like is uncertainty. And to Steve's point, I think that volatility and uncertainty is here for a little while. But again, things can change very, very quickly. If the US and China come up with some agreement, markets will turn. We saw last night, the US market finished down, but it actually opened up pretty strongly and then drifted off as Trump stood his ground versus in terms of the tariffs that he wants to impose on China. So it's really up in the air. Anyone that thinks they can forecast what's going on we don't believe that anyone can. We don't believe them. So, really we'll focus on the numbers rather than the story behind the numbers. But I think some elevated uncertainty and volatility is probably here for the near term.
And with that message, the important point that you're saying, if I'm hearing that correctly, is that you're staying invested, you're staying in the market, but you're taking advantage of the opportunities that you see within those sectors, countries and stocks.
Absolutely. We're out there making active decisions, buying and selling shares over and underweights, but we're making those active decisions across all segments, all markets around the world, and within the Australian market, across all industries, picking up mispricing opportunities where stocks may be oversold, so forth, or the relative spread between some of the outperformers and underperformers has got a bit too wide. We can certainly take advantage of that. We're going to see some downgrades to GDP forecasts. The chance of a recession in the US has gone from possible to probable. But don't underestimate the resilience of the US economy over the next 6 months or so, and it might surprise a few people. That's my personal opinion.
Well, thanks very much, guys, for joining us today, and thank you very much for listening. As Steve mentioned earlier, we're extremely delighted here at Magellan to be bringing the Vinva products to the wholesale retail market, and please click on the website to find out more information or talk to your Magellan representative. Thanks again.